Aleem, the real estate board licensed real estate agent serving Philadelphia and the surrounding counties. And welcome to Real Estate with Soul. On this podcast, we talk with dope people making moves in a real estate industry. And today we're talking about, will there be a foreclosure frenzy in the Philadelphia market? Now, I wanted to bring a couple of my real estate friends on. I do have who I do have right now is I have Lester L. Brown from Affiliate Mortgages. Man, Lester, why don't you introduce yourself and tell us a little bit about your business?
Yeah, so thanks for having me. First of all, we've been linking up for years at this point. So
Right.
thanks for having me on the podcast. So my name is Lester. I'm the co-founder and COO of Affluent Mortgage. So basically, we are a boutique style mortgage brokerage. So our job basically is to find the best option for you, the buyer, when you're in search for your real estate needs. So if you're buying residential, commercial, multifamily investments, owner occupied, our job is to really go out, search the different banks that are available to us and to you, and try to find you the best offer, whether that's rate, down payment, product, whatever it is. Our job is to shop for you and make sure you're getting, the best possible option for your mortgage needs.
Great, man. Now, how did you get into mortgage? I'm always fascinated about people's backgrounds. How did you get into doing mortgages?
Yeah, so I started out actually as a housing counselor right around the time when the mortgage bubble hit. So I worked with people who were going through foreclosure, trying to help them save their properties, either through PHFA's assistance programs. Some people did bankruptcy, some people lost their houses. So that was kind of my introduction to the mortgage industry. Then from there, I went on and I did short sales and deed in lieu with Bank of America. So another introduction into people losing their properties. This time it was more so a voluntary situation versus involuntary, where the bank is just going to take the home from you. So with short sales and deed in lieu, the bank is going to say, hey, you know give us the house back. It won't be as detrimental as a foreclosure, even though from a purchase perspective, it's still going to have some ramifications, but it's more voluntary than involuntary. Then from there, I went to another medium-sized mortgage company and kind of, cut my teeth underwriting, processing, doing all those things in the back office that people don't see during the mortgage process. So while I was there, I got tapped on the shoulder by the head of sales. And he's like, yo, man, what do you think about being a loan officer? And I was like, nah, man, I'm cool, bro. But thanks for the opportunity and
Right.
appreciate it. And he was persistent, and I finally said, all right, let me see what this is all about. And at that
Mm.
time, at that company, the way you became a loan officer was you sat under another loan officer as their assistant for 2, 3 years to kind of learn the game. I came directly from the back office into a front facing sales position with no experience, no knowledge of sales, nothing. And they were pretty much just like, go out there and use your charisma to kind of generate business. It was horrible, man. It was horrible. But
Right.
here I am, like 7 years later, and we started
Right.
our brokerage. We got licensed in Delaware in December of 22. So we're a fairly new company, but I've been in the industry for years, and my partner's been in the industry for years as well.
Well, that's perfect, man, because we're talking about foreclosure frenzies, and that's where you started as a housing counselor. Now, you mentioned the bubble, so I'm assuming this is what, 2009, 2008?
Yep, yep.
Okay, so at that point in time, a lot of people are losing their houses. A lot of people coming to you to try to save them from losing their
Hmm.
house.
Yep.
Okay, gotcha. Now, during that time, I guess, what's some of the things that you've seen? I mean, what's some crazy stories from that time
Yeah.
that you've seen?
Yeah. So number one, the biggest thing is in Pennsylvania, and this I'm pretty sure this is still happening. When you are 3 months behind, you'll receive what's called an Act 91 notice. Basically, what the Act 91 notice is, a notice from the bank saying, "Hey, you are in um, you're in jeopardy of going into the foreclosure process. So you
Right.
have, however many days to get the mortgage caught up, blah, blah, blah. So what I saw as a housing counselor was people would get that Act 91 at 3 months and they wouldn't call us until month 8. So it's like
Mm.
now, you know, you've been behind on so many months of possible mediation that it's almost impossible for you to get caught up. So let's say
Right.
your mortgage payment is $1,000 per month. At 3 months, 3,000 plus fees, you might be at, like, let's say 3,500. 8 months, you might be at 10 racks with the amount that you're behind plus the fees that they're going to tack on. So 3,500 versus 10 racks is definitely a huge jump. So at that point, um, it's almost like you're going to need an act of God, especially if you're in a situation where you don't have even $1,000. You
Right.
definitely won't have the $10,000. So the first thing is to reach out to your bank as soon as you know you're going to have some type of problem. Month one, like there's no need in waiting. You don't gain anything from waiting until you get the messages or they're calling you back, crazy. Once you know, damn, I'm about to miss this payment, hit your bank up. Sometimes your bank will say you have to be behind for 3 months before we'll do anything for you. So they may say, all right, we recognize you're going to be behind, but we can't start the modification process until you're 3 months behind. But at least you're getting in front of it and you're letting the bank know. So when you call in, they're going to be more willing to make a play for you. But if you call them at month 10 and you duck them for 10 months, like
Right.
it's like nobody trying to hear that, no matter how sob the story is. So early intervention for sure.
Gotcha. Now let's step back, man, because of course I know what you're talking about, and people who are in the real estate industry know what you're talking about. But there may be some
Mhm,
young investors on here as far as exactly what a foreclosure is.
mhm. Yep. So foreclosure, technically, and most people don't know this. You're technically, it's 91 days if I'm not mistaken. So once you go 91 days behind, you're technically in foreclosure. The mortgage company may not start the foreclosure proceedings, but
Mhm.
they'll get the people in place. So basically, they'll get their attorneys, they'll get their foreclosure team, and what that means is if you go into foreclosure, the bank is basically saying you are in default of this mortgage, and we plan to basically repossess the house from you. So we're going to get the sheriff involved, the courts involved. We're going to get a court order, and we're going to take over that property that technically is not being paid for, and we're going to take it back from you in a short amount of time.
And what I always feel like is important for people to know is that a foreclosure is a court case.
Hmm.
So that's what it is. It's a court case. So like you said, they're getting their team of lawyers, and they're going down to the court and they're
Yeah,
making a case that hey, this person promised to sign or promised
yeah,
to pay, and now they're not paying. And now we need to take their home. So
yep.
they gotta really be cognizant that this is kind of going on in a
Hmm.
background. They're not just pushing a button and you're in foreclosure.
Correct. And
And
the crazy thing is that's why those fees are so astronomical at month 8 because they're going to add on the
right,
attorney fees that they had to pay, the court costs that they had to incur to get to the point of actually starting the process. The banks don't really want to stay; they want you to pay. Like they
right.
don't really want to take the house. They don't want to be landlords. They don't want to be trying to put this on the market with, listening with you, trying to get somebody else to buy it and hope. They want
Right.
you to pay. So if you can reach out earlier to kind of make things, I'm not gonna say smooth because when you're behind, everything is bumpy. But to make that getting caught up process smoother, the sooner the better, man, for sure. From my experience.
Gotcha. Now, as far as foreclosures, from what I know, there's three types of foreclosure. You have the pre-foreclosure, and that's when you start to become, like you said, behind in your payments. And I think that you mentioned at day 91 is when they
Hmm.
start the court proceedings.
Hmm. Yeah.
Okay. So then after that, they do the court proceedings. And then when the judge smacks the gamble and says, okay, this is in foreclosure, they call that foreclosure on the court steps. And
Yep.
then if it doesn't sell at that point in time, the asset manager gives it to a real estate agent. And now that real estate agent is selling it for example, Bank of America. and
Yep.
whatnot. So I guess during your experience, were you just working with the individuals, or were you working with the asset managers too?
Yeah. So at that time, we only had approval to do counseling through PHFA, and we were working to get um, funding, or not even funding, because we didn't really need the money. We just wanted the funding to do the conciliation conferences. So back at that time, they had the conciliation conferences where you, as the housing counselor, would go down to the courthouse with the borrower. You would speak to someone from the mortgage company and try to come up with a resolution before it went to foreclosure. So I never got the chance to deal with the mortgage company directly, but
Okay.
you will have a chance to speak to someone at the mortgage company. But like I said, once you get eight, nine, not only are they pissed off that you ducked them for so long, now they're looking at it's more like a business thing. Like, all right, you're gonna have to have 5 racks, seven. Like, you got to
Right.
have something. Like, whereas at month three, they might be like, all right, we can throw it to the back because it's not really that much bread. But now it's a hassle for them, and they're like, you need to bring something to the table in order for us to really want to do something to modify this loan. So that's another thing you have to take. The longer you wait, the more they're just going to be just not willing to help you.
Listen, I got a painful story. When me This was before I was a realtor. Um, Me and my wife was trying to buy this home, and we seen a home, beautiful home. We went, put a offer on it, put it in contract. We get to the day of closing and find out that the house is in foreclosure.
Hmm.
So none of the realtors knew, but it came back. I mean, now a realtor, now I understand the title company finds this out. So the title company at some point in time found this out, and we were ready to buy it. And we were
Hmm.
ready to buy it, I think, for like maybe like 150,000,
Yep.
but they just didn't care. They just said, "No, it's going to auction." And it went to auction and they got like 90 for it.
Hmm.
And it was
Yep.
and then to add injury to insult, what we actually did is we bought the house across the street, but that house was better. So every time my wife see it, she'd be like, "Oh, that's our house. That's our house."
Right. It's like, so working in short sales at Deed and Lou, you kind of see the thought process of the bank. Like, it's more so like, all right, do these numbers make sense? Because they're looking at it like, all right, you may be offering 150, but that deal may go through. You got to get financing 30, 40 days, blah, 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 where this joint is already ready to be going at the 94. So we're doing things from an emotional standpoint as buyers in these
Right.
transactions for the most part, unless we're investing, we're doing it from an emotional standpoint, and the bank is more so looking at it from like, all right, I'm cutting my losses. I'm trying to get out of this. I don't want to deal with this person, blah, blah, blah. Let me just get my 94, write off the loss that I took on the rest of it and keep it moving, man. So it's definitely a different thought process, and you have to kind of put yourself in that mindset when you're trying to go for these type of distressed properties.
Right. Now, at that time, can you shed a little bit of light on why there were so many foreclosures at that time?
Yeah, so basically what happened in the mortgage industry got pretty much, we took the fall for the mortgage crisis. So it was a lot of bad loans being given to people who shouldn't be in those loans. So the rigorous methods that we go through now to kind of make sure that someone is qualified to get approved for a mortgage, those measures weren't in place back then. So it was like, all right, you breathing, you got a social security number, and you told me you made $100,000, a month. Approved. Here go $1 million credit. And it's like, it's like, nah, bro, that's not how any of this should have worked. Um, but it was a lot of just bad loans. Um, Loan officers making two, three, four, five, 6, 7 points. So it's like, for a loan officer. So let's say I'm a loan officer and I can decide how much I make for a loan percentage. Am I going to be, most loan officers be like, yo, let me get the 10 points, like, or let me get the
Right.
however many points I can get for the
Right.
deal. but the higher the points is usually the riskier type of product that they're going to put you in. So everybody was complicit. Like the homeowners knew, and the way I know this, my grandma, she got a $500,000 home during that time. She
Wow.
didn't work. She didn't do she didn't do any of that. She was like, I don't know how I got this house. Now, luckily, my aunt was living there and my aunt was able to pay the mortgage. But you
Okay.
take a regular person who isn't in that position, even 200,000. Like, so she had a $500,000 home, nice joint in Jersey, and she was like, I don't, but she had good credit. Like she had almost an 800 credit. So they like, yo, you got the credit score. You can tell me what the income is. We in. So
Right.
luckily, my grandmom had someone to pay the mortgage, or else she would have been part of that process as
Mm.
well. So it was a lot of bad loans that were made, and eventually that somebody is going to hold the bill for that. So that's how those foreclosures came back in 2008.
And that's super funny because at that point in time, I was in the Washington, D.C. area, and I had a good friend of mine. He was with Countrywide. And I mean, he would call me up every day. Come on, man, come get this money. He's like, man,
Right.
we just giving out loans. He's like, listen, man, you can make, like you said, 5, 6, 7, 8 points on there.
Yeah.
And I used to be down in his basement because I was a financial planner at that time. So
Mhm.
some of the people I would work with, and I'm hearing him, and he just like, listen, um, now you only make this, but just tell them that you make $100,000 a year. You tell you make a hundred
Right.
thousand dollars a
Right.
year, you good.
Hmm. Hmm.
Uh, so it was just like, wow.
Hmm.
And I remember that just because he was making money hand over fist. And he
Absolutely.
was like, listen, man, it's easy. He's like, I don't know nothing about real estate. He's
Right.
like, man,
Right.
this is so easy.
Right.
Um,
Right.
so it was like, wow. So but I guess that's one aspect of it. Also, the other aspect of it is that there was a lot of inventory. The
Hmm.
inventory, there was a lot of inventory out there. So when you have a lot of inventory and you have these bad loans,
Yep.
then I mean you got spontaneous combustion. Is that what they call
Yep.
it?
The perfect bubble. Yeah. Yep.
So now people, because a lot of people at that time, if you go in the newspapers and you look at the rhetoric that the news was putting out at that time, don't buy a home, don't buy houses. It's going down and the market's going down and you guys are
Hmm.
crazy to buy a home. Well, that was the best time to buy a home.
Yep.
Um, which is kind of different than this time. So what are you seeing now in the market in reference to foreclosures?
Yep. So I definitely feel with us slowly coming out of COVID, um, these banks are going to be like, yo, man, I need my bread. Like we put this off for long enough, and at some point they're going to come knocking for the money that they either put to the back, or they said, all right, you got the moratorium, you don't have to pay, blah blah blah. I think it's good. What I think is going to happen, and it's twofold. I think we're going to get to a point where you're going to see foreclosures skyrocket.
Mm,
Um, but the problem with that is you're going to see lending tighten up.
mm,
So while these prices are going to be cheap, you ain't going to be able to get them. So if you a 600 credit score person and you're able to get a house right now, down payment this stuff is going to magically just disappear. Like down payment assistance is going to
mm.
disappear. The
Right.
minimum credit score is going to go up. It's going to be 700, 720. The down payment may increase. So while it's going to be a great time to buy, it's really only going to be a great time to buy for people who are positioned properly. So if you've been stacking your bread for the last couple of years or working on your credit for the last couple of years, you'll be in position because you'll be less of a risk than someone who's working on their credit, collections, no money, no down payment, and you're trying to get a crib. So I think the foreclosure numbers are going to go up for sure, but I also think the lending is going to get way tighter. Like we see banks failing. We've seen just two in the last month or so, two or three in the last month or so. So as that starts to happen and more foreclosures happen, there's going to be less players in the game. And I look at it as everything is a cycle. So it's like
Mm,
you can't get into the game and expect to get all gains. Like that's just not realistic. So you have to kind of either be able to ride the wave or get off and wait for the next wave to come around so you can earn off of it. So for the people who are positioned, it's going to be a great time. Like investors, they about to go, they're gonna go ham because it's gonna be the inventory that we're lacking right now is gonna be back and it's gonna be at a discounted price. Um, but I just don't know when that's gonna be. Like we've been sitting on this bubble for a long time, and it's I would say we're in this bubble for about a year or so at this point. Um, and it's just a matter of time before everything kind of collapses and rebuilds itself.
Right? Because they say when money is easy to find, the deals are hard to find.
Hmm.
And when the deals are hard to well, when the money is hard to find, the deals are easy to find.
Yep. Yep.
You
It
know what I
makes
mean?
perfect sense. Yep. It
Right.
makes perfect sense.
So but I guess the caveat to that is that right now in Philadelphia, our monthly housing supply is only at like 1.37.
Hmm.
So if we board up all the homes in Philadelphia, it would take less than a month and a half. And for a healthy market, months of supply is usually these 6 or 7 months.
Hmm.
So I guess with not enough inventory out there, I guess one would say, how would you see there being more foreclosures? Because there's just not house. Number one, there's been a run up as far as equity. I think in
Hmm.
Philadelphia, the average equity was like 31%. And I
Hmm.
think that's the reason why they jumped on that tax reassessment so they can kind of capitalize on that.
Hmm.
But that's another show. Um, but for that, it's kind of like where do the foreclosures come? Because really, a lot of those people who would have been foreclosures back in the day, because of the equity run up, they can sell their home because they have that equity in there. So,
Hmm.
what do you think about that?
Yeah. So even with the even with the ability to sell, most
Mm,
people may so you gotta look at it like this. You may be able to sell your house, but if you're 3 months behind on your mortgage payment, you're not
mm,
getting another mortgage. So you're gonna be renting.
mm,
So a
okay,
lot of people, and this is the problem that we're having, everybody refinanced, during the refinance bubble, and people
right,
have rates in the twos and threes,
right,
and they're not getting that. So they're going out in the market right now, they're in the sixes and sevens. So it's like,
right,
why would I give up this to get something else? So what, like you said, they'll be able to sell, but they're not going to be able to purchase. It's going to be renting, and that's going to be the conclusion for a lot of people. You can sell the property, but what I've noticed is a lot of people wait until it's too late to get to a point where they even try to make a move. So people get that Act 91 notice and don't act on it for months. And it doesn't mean like normally a foreclosure can take like 9 months, but you don't know if they're, how aggressive this bank is going to be. Like they don't have to give you 9 months. So you're like, nah, I'm cool. Somebody told me I got 9 months. They at the
right,
courthouse at month 5.
right.
You a rat
Wow,
thinking that you got more time. So you
right,
you don't really know how long that proceeding is going to take, especially when it's not that many. It may be 9 months when it's thousands in the pipeline.
right.
But if it's hundreds, they might be able to get through them joints quick. So I just think acting quick. If you know you're in trouble and you know that you are having a problem holding on to this asset, cash out. Like you said, cash out and try to get your bag, and then you got to rent and start over. There's nothing wrong with renting and starting over and kind of getting your footing back under you and then getting back out there. But doing nothing is the absolute worst thing that you can do.
Right, to sticking your head in the sand.
Hmm.
That's definitely something that you don't want to do. Now, turning our attention to investors, okay?
Hmm.
Because a lot of investors come to me, and it's like because of that boom in 2008, 2009, where foreclosures was like a tag word,
Hmm.
foreclosures, 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 which to me is like a dog whistle for like cheap homes.
Hmm.
Um, and and people don't understand what comes with the foreclosures. So I guess when they're coming to you and they're telling you, "Hey, I want a foreclosure," I guess where are you steering them to?
So luckily for me, I don't have to deal with any. properties until they're under contract. So my thing
Okay.
mostly is to make sure that they qualify. And if we're talking an investor, depending on the product, it really is make sure that that property is going to qualify. So if we're doing like a DSCR loan, I don't necessarily care about what his income and all that kind of stuff looks like. I'm more so looking at the property and making sure the property can generate the income. So I would say, lean on your agent, have your agent find the best amount of, properties that work for your situation, and then send them to me and let's run the numbers and make sure that this deal makes sense for your specific situation.
Now, I guess that's my next question. If I am a investor out there looking for a home, usually these foreclosures are as is. A lot of times they're ran through because somebody's
Hmm.
getting kicked out their house. So a lot of time they trash the house. So
Yep.
I guess what's my chances of getting a loan for something like that?
Yeah. So the funny thing is, there's loans for every type of situation.
Mhm.
No matter what you're trying to do, there's somebody who's heard of it and is willing to lend some money to do it. So for those type of properties for investors, you're probably going to want to go hard money to start, and then you're probably going to want to do a DSCR type loan on the refinance if you're going to keep it. If not, you can just sell it and keep it moving. So yeah, hard money is probably going to be the best way for you to get one of those properties that has some distress and needs to get renovated. You need some money to do it. You don't want to necessarily use your money. You use hard money. Let them fund the project. You put some skin in the game, and then you kind of recoup after you've done the process.
Now, for those who don't know, why don't you explain a little bit what hard money is?
Yep. So hard money it's a private financing. So it's not like Fannie Mae, Freddie Mac, conventional, all those. It's basically usually it's a pool of people that have money. They put their money together and they invest in assets. So basically what they're gonna do is you're gonna go to them and you're gonna say, hey, I have this property, it's 100,000. After repairs, it may be worth 200,000. So I need the money to purchase it and to put the money in so that we can get the 200,000. They'll ask for you to put some money in the game, depending on the investor. 10, 20%, whatever, 30%, whatever they ask for you to put in the game. And then they'll give you the money for the acquisition as well as the rehab. And then once you sell it or refinance, that's when they get paid their money back and the fees and everything.
Nice, nice, nice. Now, I guess I'm switching our focus a little bit. Why don't you tell us about your company, Affluent Mortgage?
Yep. So we are, like I said earlier, we're a boutique style brokerage. So what a broker does is we shop different mortgage companies for you. So right now, I think currently we have about 18 different lenders that we're approved to do business with. So you come to us, let's say you come to us and you're like, yo, I got a 580 credit score. I got 20,000 in the bank, but my credit took a hit. My job is to go out, find someone whose credit scores jive with the 580, run it through, see if they're going to do the deal. Boom, put you in with that lender. A lot of people are used to going to a direct lender or a bank or a credit union, blah, blah, blah. The difference between us and the bank or the credit union is the flexibility. So the banks and credit unions are tied to the products that they have in house. So if they don't have it in house, they're going to say, well, you can't, you have to be at a 620 to do, to get approved because that's what their company requires. Whereas me, I can go and find the product that works for your specific situation. And even if I'm not approved with that lender, fill out an application, send them some documents, and we'll get approved so that we can do the deal for you. So it's a little bit different from what a lot of people have been trained to think. We've been trained to think that brokers are, trying to get over on you or they charge you a whole bunch of fees. We're paid by the lender. So the only time you're going to see extra fees from a broker is when they're charging you because the deal is not working for whatever reason financially. So, like your rate may be too crazy. We have to switch you over to you paying our fee versus the lender paying our fee. So usually when you go through a broker, the broker is gonna be getting paid from the lender, not from the borrower. And usually it's a specific situation, investor deals, jumbo deals, things like that is when the borrower is going to be expected to pay our compensation. So those are the big differences. We can find different lenders to do different loan products, whereas a bank or a credit union is really tied to the products that they have in house only.
Gotcha. Now, I guess lately, where have you guys really shined at? Where, I mean, people are coming to you and you guys are kind of the last stop for this particular loan. What product are you guys really shining for these days?
Yep. So DSCR is really a really big loan for us right now. So basically, what that does is it's an investor loan. So you already have to have a primary residence. And basically, what they're doing is, as long as you have a qualifying credit score, I've seen it. I've seen it as low as 620. I haven't done one at 620, but if you're around 680 on the credit side, you have a primary residence. They're not looking at your income as the borrower. They're looking at the income that the property is going to generate. So let's say you're buying a house for 400,000, your mortgage is 3 grand, and you can rent it out for 3,500. The mortgage company doesn't care because it's making more than the mortgage. Now, you as the investor might be like, I'm this is not a good deal for me because there's not enough in there for me to do the deal. But the
Right.
bank doesn't care because they're just looking at the income that can be generated and is it enough to sustain the mortgage. So the DSCR is a really good hot loan for investors that have a primary residence and are looking to get into the game and do some more investing.
Okay. And with that, I guess, like, just to reiterate, the important thing about that is that they're not looking at your income. They're looking at what the property is going to make. And I'm assuming that you can do that for single family, multi-unit,
Yep.
commercial too.
Yeah. Commercial DSCR. Yep.
Okay, commercial too. Okay. Yeah, that definitely sounds. Now, usually in those you're putting down what, 20%?
Yeah, yeah, and it usually depends. Another thing, it depends on the lender. So some lenders may say 15, some lenders may say 20, some lenders may say 25%. So it's up to me to find the lender. So the lender that says 25%, they may have a 660 credit score requirement. So it's like, all right, well, this is why they want more down because your credit score is not as good as somebody else. So you got to look at the factors and kind of say, all right, this is the reason why they're doing what they're doing or why it looks different than this person over here. And it's my job to find those people and then explain to the customer, like, this is the reason why these aren't necessarily apples to apples. You're coming in with a 660, this person's
Right.
coming in with a 720. Their risk is a lot less than yours. Because at the end of the day, even though the property is going to generate money, they still want to know that in the event that something happens, you're credit worthy enough to jump in and make this payment, however you're going to do it. Because most of these people are business owners. They have buku money or they have money off the books or money that's not showing on tax returns. So you're like, hey, I know you got some bread somewhere because you just put this 20% down. So but I know credit wise, if anything goes crazy, you're not just going to walk away. You're going to keep that vessel moving forward.
Gotcha. Now your boutique brokerage is in Delaware only, or you in Pennsylvania also?
So we're licensed right now in PA, Delaware, Florida. We're working on Maryland and Virginia as we speak, and we'll add New Jersey at some point too, probably um, second part of this year.
Okay. Why Florida?
So my my business partner is from Florida, so he was
Okay.
already licensed in Florida, so it just made sense to kind of get that license. Plus, he has brokerage connections down there of people that wants to send deals to him, so kind of made sense for him to get that Florida license on deck from the jump.
No, I love it. I love it, man. Well, listen, man, this has definitely been an information packed episode, man. Why don't you tell everybody where they can find you at?
Absolutely. You guys can jump on the website. It's www.affluentmtg.com. So AFFLUENT MTG.com. From there, you can click on my bio, apply, get all my contact information, ask me questions, text me. My cell phone number is 856-270-6579. So if you have any questions, want to run a scenario by me or something, shoot me a quick text, and then I'll try to get the answer for you, and we can see, how we can put a deal together for you.
Awesome. Well, this has been another great episode of Real Estate with Soul with your host, Khalid Nathan Aleem, the real estate boy. If you're looking to buy a home, sell a home, or invest in real estate, I got you. All right,